Audience: beginner traders, internship participants. This video serves as a structured educational guide designed to introduce beginners to the fundamentals of financial trading and Renko chart analysis. The goal of this handbook is to help interns understand how financial markets operate, how price movements can be analyzed using charts, and how Renko charts simplify market analysis by filtering noise. The video gradually progresses from basic trading concepts to more advanced topics such as risk management, backtesting, and algorithmic trading. By watching this video, interns should develop a foundational understanding required to work on quantitative trading systems and Renko-based strategy research. Introduction to financial markets. Financial markets are organized systems where participants buy and sell financial instruments such as stocks, commodities, currencies, and cryptocurrencies. These markets exist to facilitate the exchange of assets and to allow prices to be determined based on supply and demand. When more people want to buy an asset than sell it, the price increases. Conversely, when more people want to sell than buy, the price declines. For example, if many investors believe Bitcoin will increase in value, demand for Bitcoin rises, which pushes the price upward. Financial markets generate enormous volumes of price data every second. Traders and analysts study this data to identify patterns that may indicate profitable trading opportunities. Understanding the behavior of financial markets is therefore the first step in learning how to trade effectively. Types of trading. Trading strategies vary depending on the duration for which traders hold their positions. Different trading styles require different analytical techniques and risk management approaches. Scalping. Scalping is a trading strategy where traders aim to capture very small price movements repeatedly throughout the day. Scalpers typically hold positions for only a few seconds or minutes. Because profits per trade are small, scalpers rely on executing a large number of trades. For example, if Bitcoin moves from $70,000 to $70,030 within a few minutes, a scalper might take advantage of that small movement. Scalping requires quick decision-making, low transaction costs, and reliable trading systems. Day trading. Day trading involves opening and closing positions within the same trading day. Unlike scalpers, day traders may hold trades for several minutes or hours, but they close all positions before the trading session ends. This strategy reduces exposure to overnight risks such as unexpected news or market events. For instance, a trader might buy Bitcoin at $70,000 during the morning and sell it later in the afternoon at $70,600 after a short upward trend. Swing trading. Swing trading focuses on capturing medium-term price movements that occur over several days or weeks. Swing traders attempt to identify price swings between support and resistance levels. For example, if Ethereum repeatedly moves between $3,000 and $3,500, a swing trader might buy near $3,000 and sell near $3,500. Swing trading requires patience and careful analysis of market trends. Position trading. Position trading involves holding positions for longer periods such as weeks, months, or even years. Position traders focus on long-term trends rather than short-term fluctuations. For example, an investor who bought Bitcoin at $20,000 and held it until it reached $60,000 was engaging in position trading. This style relies heavily on macroeconomic analysis and long-term trend identification. Basic trading terminology. Understanding basic trading terminology is essential for interpreting market data and communicating effectively within the trading community. Asset. An asset is any financial instrument that can be traded in the market. Examples include stocks such as Apple or Tesla, commodities such as gold or crude oil, and cryptocurrencies such as Bitcoin or Ethereum. Each asset has a price that changes based on supply and demand. Order. An order is a request placed with a trading platform to buy or sell an asset. There are different types of orders such as market orders and limit orders. For example, a trader might place a market order to buy Bitcoin immediately at the current market price. Bid price. The bid price represents the highest price buyers are willing to pay for an asset. For example, if buyers are willing to pay $70,000 for Bitcoin, that becomes the current bid price in the order book. Ask price. The ask price represents the lowest price sellers are willing to accept. For example, if sellers are willing to sell Bitcoin at $70,010, that becomes the ask price. Spread. The spread is the difference between the bid and ask price. If the bid price is $70,000 and the ask price is $70,010, the spread is $10. A smaller spread generally indicates higher market liquidity. Long position. A long position means buying an asset with the expectation that its price will increase. For example, a trader buying Bitcoin at $70,000 expecting it to reach $75,000 is taking a long position. Short position. A short position means selling an asset with the expectation that its price will decline. For example, a trader might sell Bitcoin at $70,000 expecting it to drop to $65,000 and then buy it back at the lower price. Volatility. Volatility refers to the degree of price fluctuation in the market. Assets such as cryptocurrencies often exhibit high volatility, meaning their prices can change significantly within short periods of time. Introduction to price charts. Price charts are graphical representations of how an asset's price changes over time. Charts help traders visualize trends, identify patterns, and analyze historical price behavior. Instead of reading raw numerical data, traders use charts to quickly understand whether a market is trending upward, downward, or moving sideways. For example, if a chart shows Bitcoin steadily rising from $65,000 to $70,000 over several days, it indicates a bullish trend. Traders often combine chart analysis with technical indicators to improve their decision-making process. Candlestick charts. Candlestick charts are the most commonly used chart type in financial trading. Each candlestick represents price movement within a specific time period such as 1 minute, 5 minutes, or 1 hour. A candlestick includes 4 key values. Opening price, highest price, lowest price, closing price. If the closing price is higher than the opening price, the candlestick appears green and indicates bullish sentiment. If the closing price is lower than the opening price, the candle appears red and indicates bearish sentiment. Candlestick patterns are widely studied to predict potential price reversals or continuations. Limitations of time-based charts. Although candlestick charts are widely used, they have certain limitations. Because they are based on fixed time intervals, they can generate candles even when price movement is insignificant. This often results in market noise that makes trend identification difficult. For example, during low volatility periods, a chart may show many small candles moving randomly within a narrow range. These movements may not represent meaningful trends. As a result, traders sometimes misinterpret noise as trading signals. Renko charts were developed to overcome this limitation by focusing only on price movement. Introduction to Renko charts. Renko charts are a specialized chart type that focuses only on price changes rather than time intervals. Instead of using candles based on time, Renko charts use bricks that form only when price moves a specific amount. The term Renko comes from the Japanese word renga, which means brick. For example, if the brick size is set to $100, a new brick appears only when the price moves $100 from the previous brick. This filtering mechanism removes small fluctuations and highlights meaningful price trends. Renko charts are therefore particularly useful for identifying clear trends and breakout patterns. Sample Renko chart. How Renko charts work. Renko charts operate using a predefined brick size. When the price moves beyond this threshold, a new brick is added to the chart. If the price moves upward, a green brick appears. If the price moves downward, a red brick appears. For example, if Bitcoin is trading at $70,000 and the brick size is $100, a new upward brick appears when the price reaches $70,100. If the price falls to $69,900, a downward brick appears. Minor fluctuations smaller than $100 are ignored. Advantages of Renko charts. Renko charts provide several advantages compared to traditional charts. First, they reduce market noise by ignoring small price fluctuations. This makes it easier to identify trends and breakout patterns. Second, Renko charts simplify analysis because traders only need to focus on directional movement. For example, a sequence of green bricks indicates a strong uptrend. Finally, Renko charts help traders identify support and resistance levels more clearly. Limitations of Renko charts. Despite their advantages, Renko charts also have limitations. Because bricks form only after price moves significantly, signals may appear later compared to time-based charts. Another limitation is that different brick sizes can produce different chart structures. A smaller brick size creates more bricks and potentially more signals, while a larger brick size filters more noise but produces fewer signals. Renko brick formation. Renko bricks are created only when price movement exceeds the brick size threshold. For example, if the brick size is $50, a new brick appears when price moves $50 from the previous brick. If Bitcoin moves from $70,000 to $70,050, a new brick appears. However, if price moves only $30, no new brick forms. This approach ensures that only significant price movements are displayed. Market structure. Market structure describes the overall direction of price movement. Uptrend. An uptrend occurs when price consistently forms higher highs and higher lows. For example, Bitcoin moving from $65,000 to $68,000 and then to $70,000 represents an uptrend. Downtrend. A downtrend occurs when price forms lower highs and lower lows. For example, Bitcoin declining from $72,000 to $70,000 and then to $68,000 indicates bearish momentum. Sideways market. A sideways market occurs when price moves within a narrow range without forming a clear trend. Support and resistance. Support and resistance levels are key areas where price tends to reverse. Support. Support is a price level where buying pressure prevents further price decline. For example, Bitcoin may repeatedly bounce near $70,000. Resistance. Resistance is a level where selling pressure prevents further price increase. For example, Bitcoin may repeatedly fail to break above $72,000. Trend lines and channels. Trend lines are drawn by connecting price highs or lows to identify market direction. An upward trend line connects higher lows and indicates bullish momentum. A downward trend line connects lower highs and indicates bearish pressure. Channels occur when price moves between two parallel trend lines, creating a range where traders can identify entry and exit points. Moving averages. Moving averages smooth price data to identify trends. Simple moving average, SMA, calculates the average price over a specific number of periods. Exponential moving average, EMA, places greater weight on recent prices, making it more responsive to changes. Moving averages are commonly used to confirm trends. Renko strategy example. A basic Renko strategy might involve entering trades when a sequence of bricks changes direction. For example, if several red bricks are followed by two green bricks, a trader may interpret this as a bullish reversal signal and open a long position. Risk management. Risk management ensures that losses remain controlled. Stop loss. A stop loss automatically closes a trade if price moves against the position. Take profit. A take profit order closes a trade once a predefined profit target is reached. Paper trading. Paper trading is a simulated trading process in which traders practice buying and selling financial assets using virtual money instead of real capital. The primary purpose of paper trading is to allow traders to learn how markets work, test trading strategies, and gain experience with trading platforms without risking actual financial losses. In paper trading, all trades are executed in a simulated environment that replicates real market conditions. The trader can place buy and sell orders exactly as they would in a live trading account, but the transactions are recorded using virtual funds. This allows beginners to practice trading decisions and evaluate their strategies in a safe environment. Paper trading is widely used by beginner traders, professional traders developing new strategies, and quantitative researchers testing algorithmic trading models. Purpose of paper trading. The main purpose of paper trading is to allow traders to learn trading techniques and test strategies without financial risk. Beginners often make mistakes while learning how to analyze charts, identify trends, and manage trades. If these mistakes occur in a real trading account, they can result in financial losses. Paper trading provides a risk-free environment where traders can experiment with different trading strategies and observe how those strategies perform under various market conditions. It also helps traders develop confidence before transitioning to real money trading. For example, an intern learning Renko chart trading can simulate buying Bitcoin at $70,000 and selling it at $71,000 in a paper trading account to evaluate whether their strategy works effectively. How paper trading works. Paper trading works by connecting a simulated trading system to real-time market data. The system tracks the current market price of assets and allows traders to place orders just like they would in a live trading platform. The trading platform records the entry price, exit price, profit or loss, and overall account balance using virtual funds. This allows traders to evaluate their performance over time. For example, suppose a paper trading account starts with $100,000 in virtual capital. A trader might buy one Bitcoin at $70,000. If the price rises to $71,000 and the trader sells, the simulated profit would be $1,000. Although no real money was involved, the trade demonstrates how the strategy performs. Benefits of paper trading. Paper trading offers several advantages, especially for beginners and researchers developing trading systems. Risk-free learning. Because trades are executed with virtual funds, traders can experiment freely without worrying about financial losses. Strategy testing. Traders can test new strategies and evaluate their performance before implementing them in real trading environments. Platform familiarization. Paper trading helps traders learn how to use trading platforms, understand order types, and manage positions effectively. Performance evaluation. Paper trading allows traders to analyze key metrics such as win rate, profit factor, and drawdown to determine whether their strategies are viable. For example, a trader testing a Renko breakout strategy may run paper trading for several weeks to determine whether the strategy consistently generates profitable signals. Example of paper trading in practice. Consider a trader analyzing a Renko chart of Bitcoin using a strategy based on trendline breakouts. 1. The trader identifies a breakout above resistance at $70,500. 2. The trader enters a simulated buy order at $70,5. 3. The trader places a stop loss at $70,200. 4. The trader sets a take profit target at $71,200. If the price reaches the take profit level, the system records the trade as profitable. If the stop loss is triggered, the trade records a simulated loss. This process helps traders evaluate whether their trading strategy produces consistent results. Paper trading vs. real trading. Although paper trading is extremely useful for learning and testing strategies, it differs from real trading in several important ways. One major difference is psychological pressure. When real money is involved, traders often experience emotional responses such as fear or greed that may influence decision-making. Another difference is market execution. In live markets, factors such as slippage, liquidity constraints, and order execution delays may affect trade outcomes. For example, a trade that appears profitable in paper trading may experience slightly different results in a live trading environment due to these real-world factors. Paper trading in algorithmic trading research. Paper trading is also widely used in algorithmic trading development. Researchers use paper trading systems to evaluate automated trading algorithms before deploying them in real markets. In algorithmic trading research, strategies are first backtested using historical data. After backtesting shows promising results, the strategy is tested in a paper trading environment using live market data. This process helps verify whether the algorithm performs well in real-time conditions. For example, a Renko-based algorithm might automatically generate buy signals when a new green brick appears above a moving average. Paper trading allows researchers to observe how the algorithm performs in a simulated trading environment. Paper trading for internship training. In internship training programs, paper trading is an essential learning tool. Interns can practice analyzing charts, identifying trading opportunities, and managing trades without risking real money. By maintaining a paper trading journal, interns can track their trades, review their decision-making process, and improve their strategies over time. For example, an intern might record the following details in a trading journal: entry price, exit price, stop loss level, trade reasoning, profit or loss. Reviewing these records helps interns identify patterns in their trading behavior and refine their strategies. Backtesting. Backtesting is a process used in trading and quantitative finance to evaluate how a trading strategy would have performed in the past by applying it to historical market data. The primary goal of backtesting is to determine whether a strategy is likely to be profitable before risking real money in live markets. In backtesting, historical price data such as open, high, low, and close values are used to simulate trades according to predefined strategy rules. The system applies the strategy logic to past data and records the simulated results, including profits, losses, drawdowns, and other performance metrics. For example, a trader may develop a Renko-based strategy that generates a buy signal when 3 consecutive green bricks appear and a sell signal when 2 red bricks appear. By running this strategy on historical Bitcoin data from the past 5 years, the trader can analyze how well the strategy would have performed under different market conditions. Backtesting is widely used by traders, hedge funds, and quantitative researchers to validate trading ideas before implementing them in live trading systems. Purpose of backtesting. The primary purpose of backtesting is to evaluate the effectiveness and reliability of a trading strategy using historical data. Since financial markets are unpredictable, traders must test strategies thoroughly before deploying them with real capital. Backtesting allows traders to answer several important questions. Would the strategy have been profitable in the past? How much risk does the strategy involve? How often does the strategy generate winning trades? How large are the potential drawdowns? For example, suppose a trader develops a Renko breakout strategy. By backtesting the strategy on historical Bitcoin data, the trader can determine whether breakouts historically produced consistent profits or frequent losses. How backtesting works. Backtesting involves applying a set of trading rules to historical market data and simulating trades based on those rules. The typical backtesting process includes the following steps. 1. Define the trading strategy rules. 2. Collect historical market data. 3. Apply the strategy rules to the historical data. 4. Simulate trade entries and exits. 5. Calculate performance metrics. For example, a Renko strategy may include the following rules. Enter a buy trade when 2 consecutive green Renko bricks appear above a moving average. Exit the trade when a red brick appears. A backtesting system scans historical data and executes these rules automatically to simulate trades. The results help determine whether the strategy performs consistently over time. Example of backtesting a Renko strategy. Consider a trader testing a simple Renko trend following strategy using historical Bitcoin price data. The strategy rules may be defined as: buy when 3 consecutive green Renko bricks appear. Sell when 2 consecutive red bricks appear. Stop loss set at 2 bricks below the entry price. Take profit set at 4 bricks above the entry price. The trader then applies this strategy to historical Bitcoin data from 2019 to 2024. After running the backtest, the system produces performance metrics such as total number of trades, 520. Winning trades, 310. Losing trades, 210. Win rate, 59%. Maximum drawdown, 12%. These results help the trader determine whether the strategy is worth testing further. Key performance metrics in backtesting. Backtesting systems generate several metrics that help evaluate strategy performance. Win rate. Win rate represents the percentage of trades that resulted in profit. For example, if 60 out of 100 trades are profitable, the win rate is 60%. Profit factor. Profit factor is the ratio of total profits to total losses. A profit factor greater than 1 indicates a profitable strategy. Maximum drawdown. Drawdown measures the largest decline in account balance during the trading period. Lower drawdown indicates better risk control. Expectancy. Expectancy represents the average profit or loss expected per trade. These metrics help traders evaluate whether a strategy has a positive long-term expectation. Advantages of backtesting. Backtesting offers several advantages for traders and researchers. Strategy validation. Backtesting allows traders to evaluate strategies before risking real capital. Performance analysis. Traders can analyze how strategies perform under different market conditions. Risk evaluation. Backtesting reveals potential risks such as large drawdowns or inconsistent profitability. Strategy optimization. Traders can adjust parameters such as Renko brick size or stop-loss levels to improve strategy performance. For example, changing the Renko brick size from $50 to $100 may significantly affect trading signals and profitability. Limitations of backtesting. Although backtesting is a powerful tool, it has certain limitations that traders must consider. Overfitting. Overfitting occurs when a strategy is excessively optimized for historical data. Such strategies may perform well in backtests but fail in live markets. Data quality. Backtesting results depend heavily on the accuracy of historical data. Poor data quality can produce misleading results. Market conditions. Market conditions constantly change. A strategy that performed well in the past may not perform similarly in the future. For example, a Renko strategy that worked during a strong bull market may struggle during sideways or highly volatile markets. Backtesting in algorithmic trading. Backtesting plays a critical role in algorithmic trading development. Before deploying automated trading systems, developers must ensure that their algorithms perform reliably. In algorithmic trading workflows, strategies typically go through 3 stages. 1. Backtesting using historical data. 2. Forward testing using simulated live data. 3. Deployment in live trading environments. For example, a Renko-based trading algorithm may generate signals based on moving average crossovers. Developers first test this algorithm on historical data to evaluate performance before allowing it to trade in live markets. Backtesting for research and internship projects. In research environments and internship programs, backtesting is used to evaluate experimental trading strategies. Interns can design their own strategies and test them using historical data sets. For example, an intern might develop a strategy that combines Renko brick reversals with support and resistance levels. By running a backtest on 5 years of Bitcoin data, the intern can evaluate whether the strategy produces consistent results. This process helps interns develop analytical thinking and gain practical experience with quantitative trading systems. Conclusion: backtesting is a fundamental step in trading strategy development. It allows traders and researchers to evaluate strategies using historical data before risking real capital in live markets. By analyzing metrics such as win rate, profit factor, and drawdown, traders can determine whether a strategy is viable and identify potential areas for improvement. However, backtesting results must always be interpreted carefully because past performance does not guarantee future success. For this reason, successful trading strategies typically undergo additional validation through forward testing and real-time simulation before being deployed in live markets. Forward testing. Forward testing is the process of evaluating a trading strategy using new market data in real time within a simulated trading environment. Unlike backtesting, which uses historical data, forward testing applies the strategy to live market data as it unfolds. The goal of forward testing is to verify whether a strategy that performed well in backtesting continues to perform effectively under real-time market conditions. Forward testing is usually conducted in a paper trading environment, meaning that trades are executed using simulated funds rather than real money. This allows traders and researchers to observe how the strategy behaves under current market conditions without exposing themselves to financial risk. For example, suppose a Renko trading strategy was backtested using Bitcoin price data from the past 5 years and produced promising results. Before deploying this strategy in a live trading account, traders would run it in a forward testing environment where it generates buy and sell signals based on real-time price movements. Forward testing is therefore an essential step between backtesting and live trading, ensuring that a strategy performs consistently when exposed to new data. Purpose of forward testing. The main purpose of forward testing is to validate whether a trading strategy performs reliably in real-time market conditions. While backtesting provides valuable insights, it relies on historical data that may not fully represent future market behavior. Forward testing allows traders to observe how the strategy reacts to live price movements, market volatility, and changing trends. It helps answer important questions such as: does the strategy perform consistently in real time? Does the strategy generate too many false signals? Are the stop loss and take profit levels appropriate? Does the strategy behave differently compared to backtesting results? For example, a Renko breakout strategy might show excellent performance during backtesting. However, during forward testing, traders may discover that the strategy generates too many signals during sideways markets. This insight allows researchers to refine the strategy before deploying it in live trading. How forward testing works. Forward testing involves running a trading strategy on live market data while simulating trade execution using virtual funds. The strategy continuously monitors incoming price data and generates trading signals according to its predefined rules. The typical forward testing workflow includes the following steps. 1. A trading strategy is developed and backtested using historical data. 2. The strategy is connected to a simulated trading environment. 3. Live market data is streamed into the system. 4. The strategy generates buy and sell signals in real time. 5. Simulated trades are executed and recorded. 6. Performance metrics are monitored and analyzed. For example, if a Renko strategy generates a buy signal when 3 consecutive green bricks appear, the forward testing system will execute a simulated buy order whenever this condition occurs in live market data. Example of forward testing a Renko strategy. Consider a trader who has developed a Renko trend following strategy based on the following rules. Buy when 2 consecutive green Renko bricks appear above the moving average. Sell when 2 consecutive red bricks appear below the moving average. Stop loss placed 2 bricks below the entry point. Take profit placed 4 bricks above the entry price. After backtesting this strategy on historical Bitcoin data, the trader decides to forward test it for 1 month using live market data. During this forward testing period, the trading system automatically records all simulated trades, including entry prices, exit prices, and profit or loss. For example, Trade 1. Entry price, $70,000. Exit price, $70,400. Profit, $400. Trade 2. Entry price, $70,800. Exit price, $70,500. Loss, $300. By analyzing these trades, the trader can determine whether the strategy performs consistently in real market conditions. Key metrics observed during forward testing. During forward testing, traders monitor several performance metrics to evaluate strategy behavior. Win rate. Win rate measures the percentage of profitable trades generated by the strategy. For example, if 30 out of 50 trades are profitable, the win rate is 60%. Profit factor. Profit factor compares total profits to total losses. A profit factor greater than 1 indicates that the strategy is profitable. Maximum drawdown. Drawdown measures the largest decline in account equity during the testing period. Trade frequency. Trade frequency shows how often the strategy generates trading signals. Monitoring these metrics helps determine whether the strategy is stable and reliable. Advantages of forward testing. Forward testing provides several important advantages for traders and researchers. Real-time market validation. Forward testing exposes the strategy to live market conditions, allowing traders to evaluate how it performs under current market dynamics. Detection of strategy weaknesses. Forward testing can reveal weaknesses that were not visible during backtesting, such as excessive signals during low volatility markets. Improved risk assessment. Traders can evaluate how well the strategy handles real-time market volatility and price fluctuations. Increased confidence. Successful forward testing builds confidence that the strategy may perform reliably in live trading environments. For example, if a Renko strategy maintains consistent profitability during several weeks of forward testing, traders may feel more comfortable deploying it with real capital. Limitations of forward testing. Despite its advantages, forward testing also has limitations. Time requirement. Forward testing requires waiting for new market data to arrive, which means the process can take weeks or months. Limited data sample. Because forward testing occurs over a shorter time period compared to backtesting, it may not capture all possible market conditions. Psychological bias. Traders observing the strategy in real time may be tempted to modify rules prematurely based on short-term results. For example, a strategy may experience a temporary losing streak during forward testing even though it remains profitable over the long term. Forward testing in algorithmic trading. Forward testing is an essential step in the development of algorithmic trading systems. Quantitative trading strategies typically undergo several stages before being deployed in live markets. The typical development pipeline includes 1. Strategy design. 2. Historical backtesting. 3. Forward testing using simulated trading. 4. Live deployment with real capital. For example, a Renko-based algorithm may automatically generate buy signals when price breaks above resistance levels. Before deploying this algorithm to trade real funds, developers will forward test it to ensure that the signals behave as expected. Forward testing for internship projects. In internship programs focused on algorithmic trading research, forward testing provides interns with valuable hands-on experience. Interns can design trading strategies, implement them in simulation environments, and observe their behavior in real time. For example, an intern may develop a strategy that uses Renko brick reversals combined with moving average crossovers. By running the strategy in a forward testing environment for several weeks, the intern can evaluate whether the strategy generates consistent trading signals. This practical experience helps interns understand the relationship between theoretical trading strategies and real-world market behavior. Conclusion. Forward testing is a critical step in the trading strategy development process. It bridges the gap between backtesting and live trading by evaluating strategies in real-time market environments using simulated capital. By observing how strategies behave with new market data, traders can identify weaknesses, improve risk management rules, and refine trading logic. Successful forward testing increases confidence that a strategy may perform reliably in live trading conditions. For this reason, professional traders and quantitative researchers rarely deploy strategies directly after backtesting. Instead, they conduct thorough forward testing to ensure stability and robustness before risking real capital. Algorithmic trading. Algorithmic trading refers to the use of computer programs and automated systems to execute trading strategies based on predefined rules and mathematical models. Instead of manually placing trades, traders design algorithms that analyze market data, generate trading signals, and execute buy or sell orders automatically. These algorithms follow a set of instructions that may include conditions such as price movements, technical indicators, trading volume, or statistical patterns. Once the conditions are satisfied, the algorithm automatically places orders in the market without human intervention. For example, a Renko-based algorithmic strategy might generate a buy signal when two consecutive green Renko bricks appear above a moving average. If this condition is met, the algorithm automatically executes a buy order. Similarly, when the price forms red bricks indicating a downward trend, the algorithm may automatically execute a sell order. Algorithmic trading is widely used by hedge funds, financial institutions, and quantitative trading firms because it enables faster execution, reduces emotional decision-making, and allows traders to process large amounts of data efficiently. Purpose of algorithmic trading. The primary purpose of algorithmic trading is to automate the trading process and remove human emotional biases from trading decisions. Human traders often make mistakes due to fear, greed, or impulsive behavior. Automated systems follow predefined rules consistently, which improves discipline and strategy execution. Algorithmic trading also allows traders to process large volumes of market data in real time. Modern markets generate thousands of price updates per second, making manual analysis difficult. Algorithms can analyze this data instantly and react to market changes much faster than human traders. For example, an algorithmic system may monitor multiple cryptocurrencies simultaneously and execute trades whenever specific technical conditions occur. This level of monitoring would be extremely difficult for a human trader to perform manually. How algorithmic trading works. Algorithmic trading systems operate by combining several components that work together to analyze market data and execute trades automatically. The general workflow includes the following steps. 1. Market data is received from an exchange or data provider. 2. The algorithm analyzes the incoming data using predefined rules. 3. The system generates trading signals based on the strategy logic. 4. Risk management rules verify whether the trade meets risk criteria. 5. The system automatically executes the trade in the market. 6. Trade results are recorded and monitored. For example, suppose a trading algorithm monitors Bitcoin prices using Renko charts. If the algorithm detects a breakout above resistance with 3 consecutive green bricks, it may automatically place a buy order. The algorithm continues monitoring the market and exits the trade when predefined conditions are met. Components of an algorithmic trading system. A typical algorithmic trading system consists of several key components. Market data feed. The market data feed provides real-time price information from exchanges. This data includes information such as bid prices, ask prices, trading volume, and price history. For example, an algorithmic trading system may receive Bitcoin price updates every second from an exchange such as Binance. Strategy engine. The strategy engine contains the logic that determines when trades should be executed. This logic may include technical indicators, statistical models, or machine learning predictions. For instance, a Renko strategy engine may generate buy signals when price forms multiple consecutive upward bricks above a moving average. Risk management module. Risk management ensures that trades follow predefined risk rules. This module controls position size, stop-loss levels, and maximum drawdown limits. For example, the system may limit each trade to 2% of the total account balance to prevent excessive risk. Execution engine. The execution engine sends buy or sell orders to the exchange. It ensures that trades are executed quickly and efficiently. For example, when a strategy generates a buy signal, the execution engine automatically places a market order on the exchange. Monitoring and reporting. Monitoring systems track the performance of the trading algorithm and generate reports. Traders can review metrics such as profit, loss, win rate, and drawdown. Example of an algorithmic trading strategy. Consider a simple Renko-based algorithmic trading strategy with the following rules. Buy conditions. 2 consecutive green Renko bricks appear. Price is above the 50-period moving average. Sell conditions. 2 consecutive red Renko bricks appear. Price is below the moving average. Risk management. Stop loss set 2 bricks below entry. Take profit set 4 bricks above entry. When the algorithm detects the buy conditions, it automatically executes a buy order. When the sell conditions occur, the algorithm closes the trade or enters a short position. This strategy demonstrates how trading rules can be converted into automated instructions for a computer program. Advantages of algorithmic trading. Algorithmic trading offers several advantages compared to manual trading. Speed and efficiency. Algorithms can analyze market data and execute trades within milliseconds. This speed allows traders to capture opportunities that might be missed during manual trading. Emotion-free trading. Automated systems follow predefined rules and do not suffer from emotional biases such as fear or greed. Ability to analyze large data sets. Algorithms can process large amounts of data from multiple markets simultaneously. Consistency. Algorithmic trading ensures that strategies are executed consistently according to predefined rules. For example, an algorithm can monitor 20 different cryptocurrency pairs simultaneously and execute trades whenever signals appear. Limitations of algorithmic trading. Despite its advantages, algorithmic trading also has certain limitations. Technical complexity. Developing and maintaining algorithmic trading systems requires programming knowledge and technical expertise. Market risk. Even automated systems cannot eliminate market risk. Sudden market events may cause unexpected price movements. Overfitting. Strategies optimized excessively using historical data may perform poorly in real market conditions. Infrastructure requirements. Reliable internet connections, low-latency servers, and stable trading platforms are required to run algorithmic trading systems effectively. For example, if an algorithm relies on real-time data but experiences network delays, trade execution may occur at unfavorable prices. Algorithmic trading and Renko charts. Renko charts are particularly useful in algorithmic trading because they simplify price movements by filtering out market noise. This makes it easier for algorithms to detect trends and break out patterns. For example, a Renko-based algorithm may generate a buy signal when price forms 3 consecutive green bricks above a resistance level. Because Renko charts ignore small fluctuations, the algorithm receives clearer signals compared to traditional candlestick charts. Many quantitative trading strategies therefore use Renko charts as part of their signal generation logic. Algorithmic trading in research and internship programs. In research environments and internship programs, algorithmic trading is used to study how automated systems can analyze market behavior and generate trading signals. Interns may develop their own trading algorithms, test them using historical data, and evaluate their performance. For example, an intern might design a strategy that combines Renko brick reversals with moving average crossovers. The strategy can then be back-tested using historical Bitcoin data and forward-tested using simulated trading environments. Through this process, interns learn how to translate trading ideas into automated trading systems. Conclusion. Algorithmic trading represents a significant advancement in financial markets by allowing traders to automate strategy execution and analyze large volumes of market data efficiently. By removing emotional biases and ensuring consistent strategy implementation, algorithmic systems can improve trading discipline and performance. However, successful algorithmic trading requires careful strategy design, rigorous testing through backtesting and forward testing, and effective risk management. When combined with tools such as Renko charts, algorithmic trading provides powerful capabilities for quantitative trading research and automated strategy development. 23. Machine learning in trading. Machine learning is a branch of artificial intelligence that allows computer systems to learn patterns from data and make predictions or decisions without being explicitly programmed for every scenario. In financial trading, machine learning models analyze large amounts of historical market data to identify patterns that may help predict future price movements. Financial markets generate massive datasets that include price movements, trading volume, order book data, and economic indicators. Traditional trading strategies often rely on predefined rules such as moving averages or support and resistance levels. Machine learning models, however, can discover hidden relationships within market data that may not be easily visible to human analysts. For example, a machine learning model may analyze thousands of historical Bitcoin price movements and detect patterns that frequently occur before large upward trends. These patterns can then be used to generate trading signals that help traders make more informed decisions. Machine learning is widely used in quantitative finance, hedge funds, and algorithmic trading systems because it allows traders to analyze complex datasets and adapt strategies to changing market conditions. Purpose of machine learning in trading. The primary purpose of machine learning in trading is to improve decision-making by identifying patterns and relationships within large financial datasets. Human traders often struggle to analyze vast amounts of data quickly, whereas machine learning models can process millions of data points efficiently. Machine learning models can help traders predict potential price movements, identify profitable trading opportunities, reduce false trading signals, optimize trading strategies. For example, suppose a Renko-based trading strategy generates frequent buy signals. A machine learning model can analyze historical trades and determine which signals historically led to profitable outcomes and which signals resulted in losses. The system can then filter out weaker signals and improve overall strategy performance. How machine learning works in trading systems. Machine learning systems in trading operate by learning from historical data and generating predictions based on that information. The typical workflow involves several steps. First, large datasets containing historical price information are collected. This data may include open, high, low, close prices, trading volume, and technical indicators. Second, the data is cleaned and transformed into a structured format suitable for machine learning models. This process is called feature engineering. Third, the machine learning model is trained using historical data. During training, the model learns patterns that correlate with profitable or unprofitable trading outcomes. Finally, the trained model is used to generate predictions on new market data. These predictions may indicate the probability that a trade will be profitable. For example, a machine learning model may predict that a Renko breakout signal has a 70% probability of success based on historical patterns. Types of machine learning used in trading. Several types of machine learning models are commonly used in financial trading systems. Supervised learning. Supervised learning models are trained using labeled datasets. In trading, this means historical data is labeled according to whether trades were profitable or not. For example, a dataset may include thousands of Renko breakout signals labeled as profit or loss. A supervised learning model learns from this data and predicts the likelihood that a future signal will result in profit. Examples of supervised learning algorithms include random forest, XGBoost, logistic regression, support vector machines. Unsupervised learning. Unsupervised learning models analyze data without predefined labels. These models identify hidden patterns or clusters within data sets. For example, an unsupervised learning algorithm may analyze price movement patterns and group them into different market regimes such as trending markets, sideways markets, or highly volatile markets. Understanding market regimes helps traders adjust their strategies based on current market conditions. Reinforcement learning. Reinforcement learning involves training models through trial and error interactions with an environment. The algorithm learns to make decisions that maximize long-term rewards. In trading, reinforcement learning models may learn when to enter or exit trades based on simulated trading environments. For example, a reinforcement learning system may experiment with different trading actions and gradually learn strategies that maximize profit over time. Example of machine learning in a Renko trading strategy. Consider a Renko-based trading system that generates buy signals whenever 3 consecutive green bricks appear above a moving average. However, not all such signals lead to profitable trades. A machine learning model can analyze historical Renko signals and determine which signals historically resulted in profit. The model might consider several features such as Renko brick size, number of consecutive bricks, moving average slope, trading volume, market volatility. Using these features, the machine learning model may predict the probability that a particular signal will be profitable. For example, Signal A rightward arrow probability of profit, 80%. Signal B rightward arrow probability of profit, 40%. The trading system may choose to execute only signals with a probability above a certain threshold. Data used in machine learning for trading. Machine learning models rely heavily on high-quality data. In trading applications, several types of data are commonly used. Market price data. This includes open, high, low, close prices and trading volume. Historical price data forms the foundation of most trading models. Technical indicators. Technical indicators such as moving averages, RSI, MACD, and Renko brick patterns provide additional features that help models identify market trends. Market sentiment data. Some advanced models incorporate news sentiment, social media signals, or economic indicators. For example, sudden positive news about Bitcoin may influence market behavior and affect price movements. Advantages of machine learning in trading. Machine learning provides several advantages in trading systems. Pattern recognition. Machine learning models can detect complex patterns that are difficult for humans to identify. Adaptability. Models can adapt to changing market conditions by retraining on new data. Automation. Machine learning enables fully automated trading systems capable of generating signals without manual analysis. Improved signal filtering. Machine learning can reduce false signals generated by traditional technical indicators. For example, a Renko strategy may generate frequent buy signals during sideways markets. A machine learning model can filter these signals and allow only high probability trades. Limitations of machine learning in trading. Although machine learning offers powerful capabilities, it also has limitations. Data dependency. Machine learning models rely heavily on high-quality historical data. Poor data quality can lead to inaccurate predictions. Overfitting. Overfitting occurs when a model learns historical data too closely and fails to generalize to new market conditions. Market unpredictability. Financial markets are influenced by unpredictable events such as economic crises or geopolitical developments. Computational complexity. Training complex machine learning models requires computational resources and expertise in data science. For example, training a deep learning model on large financial datasets may require specialized hardware such as GPUs. Machine learning in algorithmic trading systems. Machine learning is often integrated into algorithmic trading systems to enhance strategy performance. In such systems, machine learning models act as decision support tools that analyze trading signals generated by traditional strategies. For example, a Renko-based algorithm may generate buy signals when price breaks above resistance levels. A machine learning model can analyze these signals and determine whether the breakout is likely to succeed. If the predicted probability of success is high, the system executes the trade. Otherwise, the signal may be ignored. This combination of rule-based strategies and machine learning models improves overall trading performance. Machine learning in quantitative trading research. In quantitative trading research and internship programs, machine learning is used to explore new trading ideas and develop predictive models. Interns may experiment with different algorithms such as XGBoost or Random Forest to predict the success of Renko trading signals. By comparing model predictions with actual trading outcomes, researchers can evaluate whether machine learning improves strategy performance. For example, an intern may train a model using 5 years of Bitcoin price data and test whether the model can accurately predict profitable Renko breakouts. This research process helps students understand both financial markets and machine learning techniques. Conclusion: machine learning has become an important tool in modern trading systems because it allows traders to analyze complex datasets and identify patterns that improve decision-making. By combining machine learning models with traditional technical analysis techniques such as Renko charts, traders can develop more sophisticated and adaptive trading strategies. However, machine learning models must be carefully designed, trained, and validated using proper research methodologies such as backtesting and forward testing. When implemented correctly, machine learning can significantly enhance the performance of algorithmic trading systems and support advanced financial research. Sample Renko chart analysis. Renko chart case study, TKUS trend analysis. The above chart shows a Renko chart of TKUS using a brick-based price representation instead of time-based candles. The chart includes several technical elements such as trend lines, support levels, moving averages, and buy/sell signals. These elements help traders analyze the overall market structure and identify potential trading opportunities. Renko charts are particularly useful because they remove small price fluctuations and focus only on significant price movements. This makes the overall trend and market structure easier to interpret. Market structure observed in the chart. The chart shows 3 main phases of market behavior. Initial uptrend phase. In the left portion of the chart, Bitcoin shows a strong upward trend characterized by multiple consecutive green Renko bricks. This indicates strong buying pressure in the market. The price gradually moves upward, forming higher highs and higher lows, which is a classic sign of bullish market structure. During this phase, several buy signals appear as price pulls back slightly and then continues upward. For example, traders may enter long positions when the price retraces slightly and then forms new green bricks. Trend reversal and breakdown. Around the middle of the chart, the market reaches a peak price level and begins forming red bricks. This indicates that selling pressure is increasing. A descending trend line, shown in red, connects the lower highs formed after the peak. This trend line represents a bearish resistance level where sellers repeatedly enter the market. The transition from green bricks to red bricks indicates a trend reversal, where bullish momentum weakens and bearish momentum begins to dominate. This type of reversal is often used by traders to identify potential short selling opportunities. Strong downtrend phase. After the trend reversal, the chart shows a clear downtrend structure. Key characteristics include multiple consecutive red Renko bricks, formation of lower highs and lower lows, price repeatedly failing near the descending trend line. These characteristics indicate sustained selling pressure in the market. Traders often enter short positions when price retraces toward the descending trend line and then continues downward. Role of the descending trend line. The red descending trend line acts as a dynamic resistance level. Each time the price moves upward and touches this trend line, sellers appear and push the price downward again. This creates multiple lower highs. For example, The chart shows several sell signals appearing near the trend line. These signals indicate areas where traders may initiate short positions. Trend lines are widely used in technical analysis to identify the direction of market momentum. Support zone analysis. The chart also shows a green support line near the lower part of the price range. Support levels are areas where buying pressure tends to increase and prevent price from falling further. When price approaches the support level, the chart shows multiple buy signals. These signals indicate that buyers are entering the market to defend that price level. However, because the overall trend remains bearish, many of these buy signals represent short-term pullbacks rather than long-term trend reversals. Renko brick behavior. Renko bricks help clearly identify market direction. Green bricks. Green bricks indicate upward price movement. When multiple green bricks appear consecutively, it suggests strong bullish momentum. Red bricks. Red bricks indicate downward price movement. In this chart, long sequences of red bricks highlight the strong bearish trend. Because Renko charts filter out minor fluctuations, the trend appears much cleaner compared to candlestick charts. Moving average interaction. The chart includes moving averages that act as dynamic trend indicators. When price remains below the moving average, it confirms bearish market conditions. In this chart, the price repeatedly stays below the moving average during the downtrend. Moving averages help traders confirm trend direction and avoid trading against the dominant market trend. Trading signals observed. The chart displays multiple buy and sell signals generated by the Renko trading system. Buy signals. Buy signals appear when price rebounds from support or when a short-term upward movement occurs. However, in a strong downtrend, these signals often represent temporary pullbacks rather than full trend reversals. Sell signals. Sell signals appear when price approaches the descending trend line and begins moving downward again. These signals align with the overall bearish trend and are generally considered higher probability trades. Key lessons from the chart. This Renko chart demonstrates several important trading concepts. 1. Trend identification. Renko charts clearly reveal the dominant market trend. 2. Trend line resistance. Descending trend lines act as resistance levels where sellers enter the market. 3. Support levels. Support zones can temporarily slow down price declines. 4. Pullbacks in downtrends. Even during strong downtrends, the market produces temporary upward movements. 5. Trend following strategy. Trading in the direction of the dominant trend often produces higher probability trades. Example trading strategy based on this chart. A simple Renko-based trend following strategy could be: short entry. Enter a short position when price touches the descending trend line. Red Renko bricks begin forming again. Price remains below moving average. Stop loss. Place stop loss slightly above the trend line. Profit target. Exit near support levels or after multiple red bricks. This strategy follows the dominant market direction and avoids counter-trend trades. Conclusion of the chart analysis. This Renko chart provides a clear example of how price transitions from an uptrend to a downtrend. The use of Renko bricks, trend lines, and support levels makes it easier to visualize the market structure. For beginners, studying such charts helps develop the ability to recognize trends, identify potential trade setups, and understand how algorithmic trading systems generate buy and sell signals. Learning path for interns. Learning trading and quantitative finance requires a structured approach because financial markets involve complex concepts, analytical tools, and decision-making processes. Interns should not begin directly with advanced topics such as machine learning or automated trading systems. Instead, they must first build a strong foundation in trading fundamentals and technical analysis before progressing to more advanced concepts such as Renko-based strategies and algorithmic trading systems. A well-defined learning path helps interns gradually develop their knowledge and skills while avoiding confusion and information overload. The training process should move step by step from basic market concepts to practical implementation of trading strategies. By following this structured learning approach, interns can better understand how financial markets operate and how algorithmic trading systems are designed and tested. The following learning stages outline a recommended progression for interns participating in quantitative trading research or algorithmic trading development projects. Stage 1. Understanding financial markets. The first step for interns is to develop a basic understanding of how financial markets operate. This includes learning about different types of financial instruments, market participants, and how prices are determined through supply and demand. Interns should study concepts such as stocks, futures, foreign exchange markets, and cryptocurrencies. They should also learn about exchanges, order books, and how trades are executed in electronic markets. For example, interns should understand that when demand for an asset such as Bitcoin increases, its price typically rises. Conversely, when more traders are selling the asset than buying it, the price tends to decline. Understanding these fundamental principles helps interns interpret market behavior more effectively. Stage 2. Learning price charts and technical analysis. After understanding financial markets, interns should learn how to analyze price charts. Price charts provide a visual representation of how asset prices change over time. Technical analysis involves studying these charts to identify patterns, trends, and potential trading opportunities. Interns should begin by studying common chart types such as line charts, bar charts, and candlestick charts. They should learn how to interpret chart patterns and identify important concepts such as support and resistance levels. For example, if Bitcoin repeatedly falls to $70,000 and then rises again, this price level may act as a support level. Recognizing such patterns helps traders anticipate potential price movements. Stage 3. Understanding Renko charts. Once interns understand traditional charting methods, they should study Renko charts and how they differ from time-based charts. Renko charts focus solely on price movement and ignore time intervals, which helps reduce market noise. Interns should learn how Renko bricks are formed and how different brick sizes affect chart structure. They should also understand how Renko charts can reveal trends more clearly than traditional candlestick charts. For example, if the brick size is set to $100, a new brick forms only when price moves $100 from the previous brick. This filtering process eliminates small fluctuations and highlights meaningful trends. Understanding Renko charts is essential for interns working on Renko-based trading strategies or Renko-based algorithmic systems. Stage 4. Learning risk management. Risk management is one of the most important skills in trading. Even profitable trading strategies can fail if risk is not properly controlled. Interns should learn how traders protect their capital using tools such as stop-loss orders, position sizing, and diversification. For example, a trader may decide to risk only 1% of their trading capital on each trade. If their total capital is $10,000, they would limit their risk to $100 per trade. Interns should also learn how to calculate potential risk and reward before entering a trade. Understanding these principles helps prevent large losses and ensures long-term trading sustainability. Stage 5. Practicing paper trading. After learning theoretical concepts, interns should practice trading using simulated environments known as paper trading systems. Paper trading allows interns to apply their knowledge in real-time market conditions without risking real money. Interns can use paper trading platforms to test trading strategies, observe market behavior, and develop decision-making skills. They should record their trades and analyze the results to identify strengths and weaknesses in their strategies. For example, an intern testing a Renko breakout strategy may record each trade in a trading journal and evaluate whether the strategy produces consistent results. Stage 6. Learning backtesting and forward testing. Before deploying trading strategies in real markets, they must be tested thoroughly. Interns should learn how to evaluate strategies using historical market data through a process called backtesting. Backtesting helps determine whether a strategy would have been profitable in the past. After backtesting, strategies should be evaluated using forward testing, where the strategy is applied to live market data in a simulated trading environment. For example, an intern might backtest a Renko-based trend-following strategy using 5 years of Bitcoin price data and then forward test the strategy using simulated trading for several weeks. This process helps ensure that strategies are robust and reliable. Stage 7. Learning algorithmic trading systems. Once interns understand trading strategies and testing methods, they can begin studying algorithmic trading systems. Algorithmic trading involves using computer programs to execute trading strategies automatically based on predefined rules. Interns should learn how trading algorithms process market data, generate signals, and execute trades automatically. They should also understand the components of algorithmic trading systems, including data feeds, strategy engines, risk management modules, and execution engines. For example, a Renko-based trading algorithm might automatically generate buy signals when a sequence of green bricks forms above a moving average. Stage 8. Exploring machine learning in trading. After gaining experience with rule-based trading systems, interns can explore how machine learning techniques can improve trading strategies. Machine learning models can analyze large datasets to identify patterns and predict potential market movements. Interns may experiment with algorithms such as random forest, XGBoost, or neural networks to analyze trading signals and estimate the probability of profitable trades. For example, a machine learning model might evaluate Renko breakout signals and determine which signals historically produced profitable outcomes. This stage introduces interns to advanced quantitative trading techniques. Continuous learning and research. Financial markets constantly evolve due to technological innovation, economic changes, and shifting investor behavior. As a result, traders and researchers must continuously update their knowledge and refine their strategies. Interns should develop a habit of continuous learning by reading research papers, analyzing new market data, and experimenting with different trading approaches. For example, interns may explore new techniques such as reinforcement learning, sentiment analysis, or alternative data sources to improve trading strategies. Continuous learning ensures that traders remain adaptable in rapidly changing financial markets. Zero conclusion. A structured learning path is essential for developing expertise in trading and quantitative finance. By progressing through stages such as market fundamentals, technical analysis, Renko charts, risk management, and algorithmic trading systems, interns can build a strong foundation for advanced trading research. Following this step-by-step approach helps interns develop both theoretical knowledge and practical skills. Over time, they will gain the ability to design, test, and implement trading strategies using modern computational tools and data-driven methodologies. 26. Trading psychology. Trading psychology refers to the emotional and mental factors that influence a trader's decision-making process. Even if a trader has a strong trading strategy, poor emotional control can lead to losses. Successful trading requires discipline, patience, and the ability to follow predefined trading rules without being influenced by fear, greed, or impulsive behavior. Financial markets are highly dynamic and unpredictable. Prices can move rapidly, sometimes producing sudden profits or losses. These price movements often trigger emotional reactions that may cause traders to abandon their strategies. For example, a trader might close a profitable trade too early due to fear of losing profits, or hold a losing trade too long hoping that the price will reverse. Many beginners lose money not because their strategies are incorrect, but because they fail to control their emotions. Therefore, understanding trading psychology is an essential part of becoming a successful trader. Importance of emotional discipline. Emotional discipline is the ability to follow a trading strategy consistently without allowing emotions to interfere with decision-making. In trading, emotions such as fear, greed, excitement, and frustration can significantly affect how traders behave. For example, After experiencing several profitable trades, a trader may become overconfident and start taking larger risks. This behavior often leads to large losses when the market moves unexpectedly. Conversely, after experiencing a losing trade, a trader may become fearful and hesitate to take the next valid trading opportunity. Professional traders understand that losses are a normal part of trading. Instead of reacting emotionally to individual trades, they focus on executing their strategies consistently over many trades. Fear and greed in trading. Fear and greed are two of the most powerful emotions that affect trading behavior. Fear. Fear occurs when traders worry about losing money or missing opportunities. Fear often causes traders to exit profitable trades too early or avoid entering valid trades. For example, a trader might buy Bitcoin at $70,000 and see the price rise to $70,500. Instead of following their strategy and holding the trade longer, they may close the trade prematurely due to fear that the price might fall. Greed. Greed occurs when traders attempt to maximize profits beyond reasonable expectations. Greed may cause traders to hold winning trades for too long or take excessive risks. For instance, if a trader buys Bitcoin at $70,000 and it rises to $71,000, they may refuse to take profit because they expect the price to reach $75,000. If the market reverses, they may lose the profit they had already earned. Successful traders maintain a balance between fear and greed by following predefined trading rules. Overtrading. Overtrading occurs when traders place too many trades within a short period of time. This often happens when traders feel compelled to participate in the market constantly. Many beginners believe that trading more frequently increases the chances of making profit. However, excessive trading often leads to poor decision-making and increased transaction costs. For example, a trader who enters 10 trades in 1 hour without proper analysis may experience multiple losses due to impulsive decisions. Professional traders typically wait for high-quality trading setups rather than trading continuously. Algorithmic trading systems help reduce overtrading by executing trades only when predefined conditions are satisfied. Revenge trading. Revenge trading occurs when traders attempt to recover losses immediately after a losing trade. This emotional reaction often leads to irrational decisions and larger losses. For example, suppose a trader loses $500 on a trade. Instead of accepting the loss and waiting for the next valid trading opportunity, the trader may immediately open another trade with a larger position size in an attempt to recover the loss quickly. This behavior often results in further losses because the new trade is not based on proper analysis. Professional traders avoid revenge trading by maintaining strict risk management rules and accepting losses as part of the trading process. Fear of missing out, FOMO. Fear of missing out, commonly known as FOMO, occurs when traders enter trades because they believe they are missing a profitable opportunity. For example, if Bitcoin suddenly rises from $70,000 to $72,000 within a short period, some traders may enter the market impulsively because they fear missing further price increases. However, entering trades after large price movements often leads to buying near the peak of the trend. FOMO-driven trades frequently result in losses because they are based on emotional reactions rather than careful analysis. Successful traders avoid FOMO by waiting patiently for trading setups that match their strategies. Importance of a trading plan. A trading plan is a structured set of rules that guides trading decisions. It defines when to enter a trade, when to exit, and how much capital to risk. A well-designed trading plan typically includes entry conditions, exit conditions, stop-loss levels, position sizing rules. For example, a Renko-based trading plan might specify entering a buy trade when 3 consecutive green bricks appear above a moving average. By following such predefined rules, traders can reduce emotional decision-making. Traders who operate without a trading plan often make inconsistent decisions that lead to unpredictable results. Developing patience in trading. Patience is one of the most important psychological traits for successful trading. Financial markets do not provide profitable opportunities continuously. Traders must wait for specific market conditions that match their strategies. For example, a Renko trend-following strategy may require the formation of several consecutive bricks before generating a signal. Traders must wait patiently for these conditions to appear instead of forcing trades. Professional traders may spend hours analyzing the market without executing any trades. This disciplined approach helps avoid unnecessary losses. Maintaining consistency. Consistency is the ability to apply the same trading strategy repeatedly over time. Many beginners constantly change their strategies after experiencing a few losing trades. For example, a trader might abandon a Renko breakout strategy after 2 losses and switch to another strategy. This constant switching prevents traders from evaluating strategies properly. Successful traders understand that every strategy experiences both winning and losing trades. Instead of changing strategies frequently, they focus on executing their strategy consistently over a large number of trades. Role of trading journals. A trading journal is a record of all trades executed by a trader. Maintaining a trading journal helps traders analyze their decisions and identify psychological mistakes. A typical trading journal may include entry price, exit price, trade reasoning, emotional state during the trade, profit or loss. For example, a trader may notice that most of their losses occur during periods of impulsive trading. By reviewing their journal, they can identify patterns in their behavior and improve their decision-making. Conclusion. Trading psychology plays a crucial role in determining long-term trading success. Even the most sophisticated trading strategies can fail if traders allow emotions such as fear, greed, or frustration to influence their decisions. Successful traders maintain discipline, follow predefined strategies, and manage risk carefully. By understanding common psychological mistakes such as overtrading, revenge trading, and FOMO, traders can develop the emotional resilience needed to operate effectively in financial markets. Developing strong trading psychology requires practice, patience, and continuous self-evaluation. Over time, traders who cultivate discipline and emotional control significantly improve their chances of achieving consistent trading performance. TradingView platform for market analysis. TradingView is one of the most widely used financial charting and market analysis platforms in the world. It provides traders and analysts with powerful tools to visualize price data, analyze market trends, and test trading strategies using advanced charting techniques. The platform supports a wide range of financial markets including stocks, cryptocurrencies, forex, and futures. For beginners and interns learning trading, TradingView is an ideal environment for studying market behavior because it provides easy access to high-quality charts, technical indicators, and customizable trading tools. The platform allows users to observe how price movements occur in real time and analyze historical data to understand how markets behave under different conditions. In Renko-based trading research, TradingView is particularly useful because it allows traders to easily generate Renko charts and apply technical indicators such as moving averages, trend lines, and support or resistance levels. Interns can use these tools to practice chart analysis and evaluate how Renko patterns form during different market conditions. Introduction to TradingView. TradingView is a cloud-based charting platform designed to help traders analyze financial markets and develop trading strategies. The platform is accessible through web browsers and mobile applications, making it convenient for users to monitor markets from anywhere. TradingView provides real-time market data, interactive charts, and a large library of technical indicators. Traders can customize charts using different time frames, chart types, and indicators. This flexibility allows traders to study price movements in great detail. For example, a trader analyzing Bitcoin can view price charts across different time frames such as 1 minute, 5 minutes, 15 minutes, or daily charts. This helps traders understand both short-term price fluctuations and long-term trends. Chart types available in TradingView. TradingView supports several types of charts that traders can use to analyze market data. Candlestick charts. Candlestick charts are the most common chart type used in trading. Each candlestick represents price movement during a specific time interval and displays the open, high, low, and close prices. For example, a 5-minute candlestick chart shows how the price of Bitcoin moves within each 5-minute period. Line charts. Line charts display only the closing prices of an asset over time. While simple, they provide a clear overview of the overall market trend. Bar charts. Bar charts display open, high, low, and close prices using vertical bars. They are similar to candlestick charts but use a different visual format. Renko charts. Renko charts focus only on price movement rather than time intervals. These charts display bricks that form when price moves a specified amount. This helps filter market noise and highlight trends. Interns working with Renko trading strategies will frequently use this chart type to study trend patterns and breakout signals. Using Renko charts in TradingView. TradingView allows users to generate Renko charts easily through the Chart Settings menu. Once the Renko chart type is selected, users can define the brick size, which determines how much price must move before a new brick forms. For example, if the brick size is set to $100, a new brick will appear only when Bitcoin moves $100 from the previous brick. This filtering mechanism removes small price fluctuations and helps traders focus on meaningful price movements. Interns analyzing Renko charts should observe how consecutive green bricks indicate upward trends while consecutive red bricks indicate downward trends. By studying these patterns, traders can identify potential trading opportunities. Drawing tools for technical analysis. TradingView provides a variety of drawing tools that allow traders to analyze price charts visually. These tools help traders identify key levels and market structures. Trend lines. Trend lines connect multiple price points to show the direction of market movement. An upward trend line connects higher lows, while a downward trend line connects lower highs. Support and resistance lines. Support and resistance lines help identify price levels where buying or selling pressure is likely to occur. For example, if Bitcoin repeatedly falls to $70,000 and then rebounds, this level may act as a support zone. Channels. Channels consist of two parallel trend lines that contain price movement within a range. Traders often buy near the lower boundary and sell near the upper boundary of a channel. These tools help interns visually understand how market trends develop. Technical indicators in TradingView. TradingView includes a large library of technical indicators that traders use to analyze price trends and momentum. Moving averages. Moving averages smooth price data and help identify trends. Traders often use simple moving averages or exponential moving averages to confirm market direction. Relative Strength Index, RSI. RSI measures market momentum and helps identify overbought or oversold conditions. Moving Average Convergence Divergence, MACD. MACD is used to identify trend direction and potential reversals. These indicators can be combined with Renko charts to create trading strategies that generate buy or sell signals. Pine Script for strategy development. TradingView provides a scripting language called Pine Script, which allows traders to create custom indicators and automated trading strategies. Using Pine Script, traders can define rules for entering and exiting trades based on technical indicators or price patterns. For example, a Pine Script strategy may generate a buy signal when a Renko brick appears above a moving average. Pine Script also allows traders to backtest strategies using historical data. This helps evaluate whether a strategy would have been profitable in the past. For interns interested in algorithmic trading, learning Pine Script is an excellent introduction to strategy automation. TradingView for backtesting and research. TradingView provides built-in tools for testing trading strategies using historical market data. Traders can apply their strategies to past price data and evaluate performance metrics such as profit, loss, and drawdown. For example, an intern may create a Pine script strategy that buys Bitcoin when 3 consecutive Renko bricks appear. By running the strategy on historical data, the intern can determine how often the strategy produced profitable trades. This capability makes TradingView a valuable tool for trading research and experimentation. TradingView in internship training. In trading internship programs, TradingView serves as the primary environment for learning chart analysis and strategy development. Interns can practice drawing trend lines, identifying support and resistance levels, and analyzing Renko chart patterns. For example, interns may be assigned tasks such as identifying trends in Renko charts, drawing support and resistance levels, analyzing breakout patterns, recording trade setups. These exercises help interns develop analytical skills and gain practical experience in market analysis. Best practices for using TradingView. To use TradingView effectively, interns should follow several best practices. First, they should analyze markets across multiple time frames to understand both short-term and long-term trends. Second, they should combine multiple indicators rather than relying on a single indicator. Third, they should maintain a trading journal to record their observations and trading decisions. For example, an intern analyzing a Renko chart may record the reason for entering a trade and evaluate whether the trade outcome matched their expectations. Conclusion. TradingView is a powerful platform for market analysis, technical charting, and strategy development. Its intuitive interface and extensive tool set make it suitable for both beginner traders and experienced quantitative researchers. By using TradingView, interns can learn how to analyze price charts, identify trading opportunities, and develop strategies based on technical indicators and Renko chart patterns. The platform also supports strategy development through Pine script, making it an excellent environment for experimenting with algorithmic trading concepts. Through consistent practice and analysis using TradingView, interns can develop the skills required to understand financial markets and contribute to quantitative trading research. Payloads in algorithmic trading systems. In algorithmic trading systems, a payload refers to a structured data message that contains information about a trading signal or trading instruction. Payloads are commonly used to transmit trading signals between different components of a trading system, such as charting platforms, trading bots, execution engines, and trading APIs. A payload typically contains key information about a trade signal, including the trading symbol, signal type, buy or sell, price level, time frame, and additional parameters required by the trading system. These payload messages are usually sent in a structured format such as JSON, JavaScript Object Notation, because JSON is easy to read, lightweight, and widely supported by programming languages. For example, when a trading signal is generated in TradingView using Pine script, the platform can send a webhook message containing a payload. This payload is transmitted to a server or trading bot that receives the signal and executes the trade automatically. In this way, payloads serve as a communication bridge between TradingView alerts and automated trading systems. What is a payload? A payload is the actual data content sent from one system to another during communication. In trading automation, the payload contains the trading instructions that tell the receiving system what action to perform. For example, when a trading strategy detects a breakout signal in TradingView, it may generate an alert that sends the following information. Trading symbol. Trade direction, buy or sell. Entry price. Stop loss level. Take profit level. Timestamp of the signal. All of this information is packaged into a payload and sent to the trading server. For instance, if a Renko breakout occurs for TGUSD, the payload may indicate that a buy order should be executed along with the price level and risk parameters. Payload format. Payloads are commonly formatted using JSON because JSON provides a simple structure for organizing data into key value pairs. This makes it easy for software applications to parse and interpret the information. A typical payload structure includes fields such as symbol, signal type, strategy name, time frame, price, stop loss, take profit. These parameters help the receiving trading system understand what action needs to be performed. Example payload format. Below is a simple example of a payload sent from TradingView when a buy signal occurs. Symbol, TCUSD. Strategy, Renko _breakout. Signal, buy. Time frame, 5M. Price, 70,500. Stop _loss, 70,000. Take _profit, 71,200. Timestamp, 2026-03-15T10:30:00Z. In this example, symbol identifies the asset being traded. Strategy specifies the trading strategy generating the signal. Signal indicates the trading action, buy or sell. Price represents the entry price. Stop _loss defines the risk protection level. Take _profit defines the profit target. The receiving system reads this payload and executes the corresponding trade. How payloads are generated in TradingView. TradingView allows traders to generate payload messages using alerts and webhooks. Alerts are triggered when specific conditions defined in a Pine script strategy are satisfied. For example, a Pine script strategy may generate a signal when a Renko brick forms above a moving average. When this condition occurs, TradingView triggers an alert and sends a webhook message containing the payload. A typical Pine script alert message may look like this. Symbol : ticker. Signal : buy. Price : close. Strategy : Renko _strategy. The placeholders such as ticker and close are automatically replaced with real market data when the alert is triggered. Sending payloads using webhooks. TradingView supports webhooks, which allow alerts to send payload data to external servers using HTTP requests. When an alert triggers, TradingView sends the payload to a specified server endpoint such as https://yourtradingserver.com/webhook. The server receives the payload and processes the information to determine whether a trade should be executed. For example, the webhook server may perform the following actions. 1. Receive the payload from TradingView. 2. Validate the signal information. 3. Check risk management rules. 4. Send an order to the trading platform. This workflow allows TradingView alerts to trigger automated trades in external systems. Payload processing in algorithmic trading systems. After a payload is received by the trading server, the system processes the message and determines what action to take. The processing steps typically include 1. Signal validation. The system verifies that the payload contains valid data such as a recognized symbol and valid price values. 2. Risk management checks. The system checks position size, maximum risk limits, and account balance. 3. Trade execution. If all conditions are satisfied, the system sends a trade order to the exchange using an API. 4. Logging and monitoring. The system records the trade information in a database for performance tracking. For example, if a payload indicates a buy signal for TCUSD, the trading bot may place a market order on an exchange such as Binance. Example: trading system architecture using payloads. A typical automated trading system using TradingView payloads follows this architecture. TradingView strategy. Alert trigger. TradingView webhook. Trading server, API. Algorithmic trading engine. Exchange API, Binance/broker. In this architecture, TradingView generates signals. Webhooks send payload data. The trading server processes the signal. The trading engine executes trades on the exchange. This architecture is widely used in automated trading systems. Advantages of using payloads in trading automation. Using payloads provides several advantages in automated trading systems. Standardized communication. Payloads provide a consistent structure for transmitting trading signals between systems. Real-time signal delivery. Payloads allow trading signals to be transmitted instantly when alerts occur. Flexible integration. Payloads can be integrated with various trading platforms, APIs, and automation tools. Scalability. The same payload system can support multiple trading strategies and multiple assets. For example, a single webhook server may receive signals for BTC, ETH, and other assets simultaneously. Example use case in Renko algorithmic trading. In a Renko-based algorithmic trading system, payloads are used to transmit signals generated by Renko chart patterns. For example, when 3 consecutive green Renko bricks appear above resistance, the Pine script strategy triggers an alert. TradingView sends a payload containing the buy signal to the trading server. The trading server receives the payload, validates the signal, and sends a buy order to the exchange. Similarly, when red bricks appear indicating a trend reversal, a sell payload is transmitted and processed by the trading system. Conclusion. Payloads play a critical role in modern algorithmic trading systems by enabling communication between charting platforms, trading algorithms, and execution engines. By packaging trading signals into structured messages, payloads allow automated systems to receive, process, and execute trading instructions efficiently. In TradingView-based automation, payloads are typically generated through alerts and transmitted using webhooks to external trading servers. These servers interpret the payload data and execute trades according to predefined strategy rules and risk management policies. Understanding payload structures and how they are used in automated trading workflows is essential for interns and developers working with algorithmic trading systems. Key trading terminology. Financial trading involves many specialized terms that describe market behavior, trading mechanisms, and financial instruments. Understanding these terms is essential for beginners because they appear frequently in chart analysis, trading platforms, and algorithmic trading systems. This section introduces important trading terminology that interns and beginner traders must understand before learning advanced topics such as Renko charts and automated trading strategies. Bid price. The bid price is the highest price that a buyer is currently willing to pay for a financial asset in the market. In every market transaction, buyers place bids to purchase assets at specific prices. The bid price represents the demand side of the market. For example, if traders are willing to buy Bitcoin at $70,000, that becomes the highest bid price. If another buyer offers $70,010, the bid price moves higher. Understanding bid prices is important because they represent the immediate price at which a trader can sell an asset. Ask price. The ask price, also called the offer price, is the lowest price that a seller is willing to accept for an asset. The ask price represents the supply side of the market. When a trader wants to buy immediately using a market order, the trade is executed at the ask price. For example, if sellers are willing to sell Bitcoin at $70,020, this becomes the current ask price. In trading platforms such as TradingView or exchange order books, the bid and ask prices are displayed together. Spread. The spread is the difference between the bid price and the ask price. Spread equals ask price bid price. For example, bid price equals $70,000. Ask price equals $70,020. Spread equals $20. Spreads represent transaction costs in trading. Markets with high liquidity usually have very small spreads, while less liquid markets may have larger spreads. Slippage. Slippage occurs when a trade is executed at a price different from the expected price. This typically happens during periods of high market volatility or when large orders are executed. For example, Suppose a trader places a buy order for Bitcoin at $70,000, but the trade is executed at $70,030 due to rapid price movement. The difference of $30 is considered slippage. Slippage is common in fast-moving markets and must be considered when designing algorithmic trading systems. Volatility. Volatility refers to the degree of price fluctuation in a financial market over time. High volatility means prices move rapidly and unpredictably, while low volatility indicates relatively stable price movements. For example, cryptocurrency markets such as Bitcoin often experience high volatility, where prices may move several $100s within minutes. Volatility creates both opportunities and risks for traders. High volatility can generate large profits but also increases the potential for losses. Block trade. A block trade refers to a large transaction involving a significant number of shares or contracts. These trades are usually executed by institutional investors such as hedge funds, banks, or asset management firms. For example, if a large institution buys 10,000 Bitcoin contracts in a single transaction, it is considered a block trade. Block trades can influence market prices because they represent substantial buying or selling pressure. Market news impact. Financial markets are heavily influenced by news and economic events. Major news announcements can cause rapid price movements because traders adjust their expectations about the future value of assets. Examples of market-moving news include central bank interest rate decisions, government economic policies, company earnings reports, geopolitical events. For example, positive regulatory news about cryptocurrency adoption may cause Bitcoin prices to rise rapidly. Traders must therefore monitor news events while analyzing technical charts. Fibonacci retracement. Fibonacci retracement is a technical analysis tool used to identify potential support and resistance levels during price pullbacks. The tool is based on mathematical ratios derived from the Fibonacci sequence, such as %, 38%, 50%, 61%. For example, if Bitcoin rises from $60,000 to $70,000, traders may expect a temporary pullback to the 61% retracement level before the trend continues. Fibonacci levels are widely used by traders to identify potential entry and exit points. Mean reversion. Mean reversion is a trading concept based on the idea that asset prices tend to return to their average value over time. For example, if Bitcoin normally trades around $70,000 but suddenly rises to $75,000, traders using mean reversion strategies may expect the price to fall back toward the average. Mean reversion strategies are commonly used in statistical trading and quantitative finance. Breakout. A breakout occurs when price moves beyond a key support or resistance level with strong momentum. Breakouts often signal the start of a new trend because they indicate that the market has overcome a significant barrier. For example, if Bitcoin repeatedly fails to rise above $72,000, this level becomes resistance. When the price finally moves above this level with strong volume, it is considered a breakout. Breakouts are frequently used in Renko trading strategies. Uptrend. An uptrend occurs when price consistently forms higher highs and higher lows over time. This pattern indicates that buyers are dominating the market and pushing prices upward. For example, Bitcoin moves from $65,000 rightward arrow $68,000 rightward arrow $70,000 rightward arrow $72,000. Traders often look for buying opportunities during uptrends. Downtrend. A downtrend occurs when price forms lower highs and lower lows, indicating strong selling pressure. For example, Bitcoin moves from $72,000 rightward arrow $70,000 rightward arrow $68,000 rightward arrow $66,000. During downtrends, traders may look for selling or short selling opportunities. Sideways market. A sideways market occurs when price moves within a narrow range without forming a clear upward or downward trend. For example, Bitcoin may move between $70,000 and $71,000 for several hours or days. Sideways markets often occur when buyers and sellers are evenly balanced. Many breakout strategies wait for price to exit a sideways range before entering trades. Equity. Equity refers to ownership in a company represented by shares of stock. For example, buying shares of companies such as Apple, Tesla, or Microsoft means the investor owns a small portion of that company. Equity markets include stock exchanges such as New York Stock Exchange, NYSE, Nasdaq. Equity trading is one of the oldest forms of financial market activity. Futures. A futures contract is a financial agreement to buy or sell an asset at a predetermined price at a specific future date. Futures are commonly used for trading commodities, currencies, and financial indices. For example, a trader may buy a Bitcoin futures contract that allows them to purchase Bitcoin at a specific price in the future. Futures trading often involves leverage, which allows traders to control large positions with relatively small amounts of capital. CFDs, contracts for difference. A CFD is a financial derivative that allows traders to speculate on price movements without owning the underlying asset. For example, a trader can open a CFD position on Bitcoin and profit from price changes without actually owning Bitcoin. CFDs allow traders to profit from both rising and falling markets, but they also involve significant risk due to leverage. Cryptocurrency. Cryptocurrency is a digital form of money that uses cryptographic technology and decentralized networks called blockchains. The most well-known cryptocurrency is Bitcoin, but there are thousands of others including Ethereum, Solana, and Binance Coin. Cryptocurrency markets operate 24 hours a day, unlike traditional stock markets that operate during fixed trading hours. These markets are known for high volatility, which creates both trading opportunities and risks. Mahesi's Internship Program. Welcome to Mahesi's Internships, where innovation meets real-world execution. If you're passionate about AI, quantitative trading, and building real systems, this is your opportunity to go beyond theory and work on live, practical projects. At Mahesi's, we don't just teach. We build, test, and deploy. Our internships are 100% learning focused. Designed around real trading systems. And every intern earns a recognized certificate. Rocket Machine Learning and Algorithmic Trading Intern. Duration, 3 to 6 months remote. In this role, you'll work directly with financial data sets and build machine learning models to predict market behavior. You'll learn how to train and optimize ML models, evaluate prediction accuracy, build structured data pipelines. This is perfect if you want to combine AI with real financial applications. Gear Algo Trading and Quant Systems Intern. Duration, 3 to 6 months remote. Here, you'll dive deep into the engineering side of trading systems. You'll work on Renko-based strategy systems, backtesting engines, risk management frameworks, simulation environments. This role is ideal if you want to build trading infrastructure from scratch. Bar chart quant trading forward tester intern. Duration, 2 to 3 months remote. This role focuses on real market validation. You'll forward test live strategies. Maintain a structured trade journal. Follow strict risk management rules. Generate weekly performance reports. This is where strategy meets reality. Lightbulb at Mahesi's, you won't just watch. You'll build, test, analyze, and improve real trading systems. Whether you're aiming for a career in AI, quant trading, or fintech, this is your launchpad. Hit apply now and start building what actually works in the real market. Mahesi's Internships. Send your profile to resume@mahesis.com. Learn, build, trade, evolve.